Thanks.
So we're at, where are we at? We're at like 18 people. I think that's kind of where I was picturing we would get. So I think this is maybe a good time to pause some of the introductions and let's welcome. So I think we got a slide limit. I'll turn it over to Tony. He can kind of do our kickoff for us.
Yeah, hello everybody. Welcome. Thanks for joining us this evening. Appreciate you being here. I recognize a lot of faces. It's great to see everybody. We're gonna spin through this somewhat quickly so that we've got a little bit of time for questions because there tends to be a lot of them. First, disclaimer, we're not raising money. This is not an offering. We are not in any way attempting to raise money from any of you at this point. That's not what we're doing. Just want to make sure we get the legalese out of the way and on the record. So this is not an offering. We'll do quick team intros. So my name is Tony Ford. I've been working with Justin and Jen as well for, I don't know, 5, 6, 7 years now in the startup ecosystem, it seems like. Built a few companies, most recently built one with Dr. John Canillas, who's on this call. We launched that in 2020, exited in 2022, just in March, to a Silicon Valley company. And I've been doing some angel investing and some private placement since then, and have been kind of working in the background with Justin on this since before we even exited that company. So this is kind of a continuation of my work with the Tucson ecosystem. Justin, you want to do a quick intro?
Yeah, thanks, Tony. So my name is Justin Williams. I've been a long time sort of tech innovation ecosystem, facilitator, creator here. My background was founded a high tech industry trade association here in Southern Arizona in Tucson. Built that for 6 years, turned it into the Tech Council about halfway through that journey. Alex Rodriguez, who's on this call, was sort of the person who took over from me and built that up to the institution that it is here in Southern Arizona. Those of you in Phoenix probably know about Steve Zylstra and the Tech Council. So I was a big part of that for a few years. And then in 2011, I launched an organization here in Southern Arizona called Startup Tucson, focused on both ecosystem development, kind of pipeline creation, focused on the startup side, so founder and company building, as well as ecosystem building. And then kind of brought together this idea for Capital Gravity with Tony and Brandon and Jen. So we're kind of shifting from helping companies develop to recognizing the ecosystem is doing a good job with that and focused on Capital Gravity. So we'll get into that in a second. Brandon?
Yeah, thanks, Justin, and thanks for everyone joining our call tonight. I'm the lone Phoenician on the Capital Gravity team. Have been a part of a number of efforts over time for incubation acceleration programs, both on the facilitation and program side, but also with my company Steady Dynamic. We're a custom software development agency, and so have worked with lots of startups and specifically early stage ones, and probably not so surprisingly, common theme, always interested in early stage capital availability. So most of the programs we've been a part of in the past have been focused on the startups. I think what's so intriguing about this one is that the focus is on the investors and really activating an angel investment community. So I'm excited you guys are all here tonight to learn more about it.
Excellent. Jen.
Hi, I'm Jen Wong. I'm in Tucson, but I do work in Phoenix. So Brandon, even though you said you're the lone Phoenician, I kind of have some presence there. My background is primarily in local government. I worked for Pima County for almost 8 years. But about 7 years ago, I met Justin and Tony and started getting into the startup scene in Tucson, loved it. So when I left the county, I decided to move towards trying to help startups and entrepreneurs. And so currently I am working for Startup AZ as the project manager, alongside with, as well as Capital Gravity as another project that we're working on. So I will just punt it back to Tony so he could start the presentation.
Excellent. Thanks, Jen. Appreciate it. For those of you who don't know me, I talk fast and I haven't had coffee in about 7 hours, but me talking fast balances Justin, who usually talks a little more measured pace, we'll call it that way. So I'm going to spin through the why on this. Before we get too far into the weeds on it, what I want you to know is we are not launching something that is a new idea. That is, it is not an unproven concept. This is something that has been launched in other cities around the country, and Justin will speak a little bit later. It's been very successful in other cities. We're taking what's working in those other cities and those other states and applying it to the state of Arizona, because we see that those successes should be something that we can replicate here. The first problem that we're trying to solve is that only 0.2% of the people who can invest in early stage startups in Arizona actually invest in early stage startups. I don't like to wait to the Hollywood ending for the reveal. I want to tell you right up front what the problem is. We just don't have a lot of activation among accredited investors. Now, why would those accredited individuals care about startup investing? Well, there's lots of places to put your money, and lots of them are very secure and low risk. But early investors who are engaged in private placement make the best returns on high growth startups when it comes down to a blended, diverse portfolio and a small percentage of what they're doing. If we look at over the last 10 years, tracking a couple of different angel groups who are tracking this, what we see is that, yeah, there's a lot of failures. Most of these investments don't go anywhere. They're losses. But because you can get some decent wins in early stage, you actually get a reasonable internal rate of return over the course of a multi-year investment in multiple startups. And it works out to be pretty solid compared to some of the other returns that are out there for other forms of investment. Certainly not your whole portfolio, but for those of us who are accredited looking for a small portion of this in something that's got a little bit higher return rate and is a little more interesting, this is an interesting place to be. High growth startups need this capital. They need the capital early. It's relatively easy once you've kind of proven the market and you've proven the value to go out and raise venture capital or later stage capital. But in these early stages where angels would mostly play, or where accredited investors might play in small private placement, there's a greatly outnumbered need for capital than there are people who are playing there, okay, who are investing there. There's 265,000 people currently estimated to be accreditable investors in Arizona. That's household wealth over $1 million, not including their primary residence. But lots of people with capital and interesting returns for those people with capital. So why is startup capital in Arizona limited? And that's a pretty common concern among all startups and all tech companies. Everybody in this state says, look, there's just not that much capital here in Arizona. Well, most of it that we know of is on the coasts. So 76% of the available venture capital, that mid-stage, is available in San Francisco, Boston, and New York, just those three cities. That's where the VC is. Alex can tell you, he flies out there to see those guys, right? Is that right, Alex? Yeah. Go get the money from those guys and those gals. But it's all concentrated out there. So we have about 500, we estimate, active angel investors in the state of Arizona across 5 angel groups. This is our best guess. So there's 500 active angels out of 265,000 people, which means 99.8% of high net worth individuals in the state of Arizona are inactive. Now, some of those are later stage in life, may not be interested in private placement, et cetera. We're not looking for all of them, but I think a subset of that 99.8% might be a good fit to activate more investment capital in the state of Arizona. It's more than $250 billion in wealth that isn't active in early stage private placement. The problem is, how do you start doing that? Because how do you vet companies? How do you learn to invest in startups? How do you learn to disqualify the companies that aren't going to be a good fit? How do you see a bunch of companies, right? This is a difficult process. And the way I describe it is that you can read a book about this, but it's not going to teach you, right? There's some startup investing myths. In Arizona, we believe angels don't write checks. The angels believe there's no good deals in Arizona, so they don't invest locally, right? So they're looking to syndicate deals from other parts of the country. We keep running into this over and over again. There's no angels here, and the angels say there's no deals here. But we know there are both accredited people and there are deals. But this is the story we keep telling. When in truth, most people who are accredited don't even know they're accredited. They don't know that they can do this. And they certainly don't know how to start. And they aren't connected to any kind of ecosystem to see anything but their nephew's startup that gets pitched to them at Thanksgiving that one time, right? They're not seeing a consistent, formalized structure of startups. So how do we teach these people, some subset of these 265,000, let's call it another 500, another 1,000, how do we teach them how to invest in early stage startups? And the truth is, we do it just the same way we teach startups to launch companies, which is in an accelerator style program. Large group people working through a very intense amount of work in a very short period of time, having lots and lots of contact with each other and with the potential startups that they might invest in. Because investing is like riding a bike. As I said, you can read a book about riding a bike, but you can't ride a bike after reading the book. You can watch a video, but you can't ride the bike after watching the video. I can tell you, you need to balance and go faster and go slower and steer, and you don't know what any of that means until you get on the bike. There's only one way to learn the bike, and that's to get on the bike. You're going to fall off the bike. Our goal is to fall on grass, not gravel, right? So we want to minimize the impact of falling off the bike while we learn how to do this. So that means we pool together so we gain reduced risk and increased impact with our dollars, diverse thought, diverse strategy, diverse experience, and a reduced workload, right? Now you say to me, how is that any different than an angel group, right? Because an angel group does these things. Well, in fact, it's different because we're running the startups and the investor tracks simultaneously. So what we're doing is we're putting a bunch of startups through the ringer together as a group of investors. Justin's going to explain how the program works. But that means we're going to go through intensive due diligence on about 6 companies. We're going to have exposure to a bunch of startups in a bunch of different life cycle stages of those startups. Because the truth is, it's really hard to pick winners, but it gets a lot easier to disqualify losers the more startups you see come in front of you. Because you start seeing what is just not going to work over and over and over again. We can learn the process for making better investments, and we connect with the people who will be successful founders. The secret I've learned in the startup community is, even if this idea is not the right idea for this founder at this time, if that founder is any good, they're going to keep coming back with the next idea, the next thing, the next iteration, the next pivot. Eventually, those founders, those people who want to go out and take risk and build something new and change the world, they hit it. They find the right niche. They find the right match. And you want to be talking to those people while they're missing so that when they hit, you can get in. And with that, I'm going to hand it off to Justin to talk about how the program works.
All right, Tony. I'm going to ask you to do the slide advancing for me.
Yes, will do.
You're running the show.
Okay.
So next slide. So we launched Capital Gravity with two kind of structures, 2 angles in mind, right? One angle is the traditional angel investing education, which does happen here in Arizona primarily through the 5 groups that we talked about. And so we're incorporating that foundation into this. And then the other piece of the puzzle is something that we've learned from the startup side of things, which is the value and the concepts behind the ecosystem development. And we do a lot of work to help, over the years, we've done a lot of work to help the leaders of the economic development world understand ecosystem building. We've done a lot of that same work with startup founders. They live it. And sort of the last group to really get a lot of ecosystem development thinking and training is there's the investor side of things. So we're kind of blending these 2 things: traditional investment education and an ecosystem building kind of mindset training. So this comes in 4, well, let me back up just a bit. This comes in 4 pieces. So we are working on bringing in new investors and doing the outreach and onboarding. We're doing the training in our community. But we're doing that, we're taking that education and enhancing it through actually doing the work, riding the bike, right? Learning to ride the bike. And then we're focused on developing leaders coming out of our program to make a difference, not just through one company or one investment or their money, but also through activating their leadership in the community. And that's a long-term benefit of this program. So how does this work? Every cohort or every year right now, perhaps twice a year going forward, we will launch a cohort. That cohort will include an investment fund, a literal fund. Every cohort will have its own, and a learning community that's brought together by the investors. So new investors come into the cohort, they invest in the fund. Active entrepreneurs come in front of the investor pool during the cohort and present their companies. A third component of this that we can talk about a little bit later is the value of having experienced investors in the program to help round out the learning process and sort of be a sage contributor to the conversations. And really what we're hoping for in that pool is that some of them will be aspiring fund managers. Tony is that role in our program in this cohort. Having done some of this on both sides, working on some fund development on his own, he's serving as the fund manager for this cohort. And perhaps some of you who have done some angel investing might want to participate in the program. And this is an opportunity to gain some experience as a fund manager. So those are the three primary roles, and they come together in one. They kind of, 1 + 1 + 1 = 4 is our vision, or 4,000. So next slide. So when they come together, they then produce on the output of this, I would say the program starts in August and ends in October. So 3-month program. Engaged investors, funded startups, and a stronger ecosystem. Those are sort of the program outputs that drive our mission. So our target is a minimum of 20, a maximum of 40 new investors. And when I say new, that's actually a blend of both first time or early in their investing career, plus what we're calling a investor in residence cohort of maybe 5 or so experienced investors. And everybody who invests in or joins the program puts $5,000 per unit into a fund. So if we have 20 of them, then we're going to end up with 100,000. If we end up with 40 of them, that'll be a $200,000 fund. That fund is then deployed at the end of the program to the winning company. So the experience that an investor will have is they'll be part of a community of 20 to 40 other investors. They will see pitches from 50, probably 25 to 75 applicants in each cohort. They will screen those applications and choose out of all the applications we might get, 24 of them to invite in to a 3-minute pitch that happens in essentially week 3 of the program. And it's 2 nights, on a Tuesday night and on a Thursday night, for about 2 to 3 hours each evening. And that's when you get to see who out of the 24, there's a little bit of Q&A for each of the companies, right? And then choose out of those the next round, which is we down select from 24 to 12. Repeat the process with a little bit longer window for the 12 companies, so they have 5 or 8 minutes, I forget, and do another round, and then choose the final 6. Those final 6, we then take our community of team members and break up into 6 due diligence teams. And it's not what I would say real due diligence is. It's really a deeper dive version of the screening process, the evaluation process. It's really validating all the things they're telling us, doing our research on them to come back and give reports back to the group at the end of the due diligence phase. And from there, we host a final event where all 6 companies come and present. If you've been to any of the pitch events that you've seen around the state or elsewhere, there'll be 6 companies presenting. And then at the end of that presentation, the group goes back, takes everything they've learned. There's a very good chance they've already identified 1 or 2 of the 6 before the final pitches even happen. And then at the end, come back and announce the winner. And this event is open to the public because this is a learning process, not just for you, but for the community, right? We're ecosystem builders, we're community developers as part of this. So, so that's the funnel, right? And here are the dates. Keep in mind that the core middle of the program, there's a weekend commitment at the beginning. That's our educational and network kickoff weekend. Then there's the demo day at the very end on Wednesday, the 28th. And then everything in between is either a Tuesday, Thursday, occasional Wednesdays, where they do the work of, where we do the work of evaluating the companies and screening them, right? But those are just evenings. Last event we had, I think people felt like they were committed all day, every day to this.
These are evening teleconference too.
Yeah, exactly. It's this for a couple of hours, right? 2 days a week. Next slide. So again, sort of summarize, our goals are to grow the number, quality, and diversity of Arizonans actively investing in Arizona startups. We have 500 or so now. we probably want in long-term get to 1,000, 2,000 of those. So we want to attract new growth capital by activating this. And then there's multipliers of this work, right? So there's a lot more potential outcomes than just $200,000 per cohort. We can talk about that during Q&A. And then the final piece of this is that we're coming in as ecosystem builders ourselves. And so we want to inspire ecosystem building thinking in the investor community, help kind of explain what that means, explain why it's so powerful, and begin to grow the network that we have of investors who see themselves as ecosystem builders as well. And then the last step here is, what can we do? So Tony, you want to talk through your last slide here?
If you're interested in doing this, you can certainly talk to one of us and sign up to be part of it. If not, and you know somebody who might be, you can email intro your network who may qualify as accredited. It doesn't matter if you know for sure. If they don't, they'll have to self-certified. And you can share this program with startup funders, right? So maybe this is the right program for you, maybe it isn't, but you might know people who are interested. I think before we get into Q&A, we should just talk through really quickly. As I mentioned, this has been done in San Diego and in Vegas and in Alaska. The same people who run the fund administration in San Diego and I think Alaska. Is that where Will does it, Justin? Both places?
Yeah, Alaska, yeah, and I think maybe Vegas.
The same team that runs the fund administration, handles the legal and the accounting, the bookkeeping, the taxes. That's handled, the same people do it for us. The people who have been involved in these, like Kai sits on our board as an advisor who's done this in Alaska. What they've found in these other cities is, while they start with, $200,000 in one cohort, all of a sudden people are interested in more startups than just the one. There's follow-on funding, there's passive investors, people come back year after year after year. And I forget the exact numbers now, but San Diego's deployed a couple $1 million, I think, through this process at this point. Right?
Yeah, let me touch on that, and then we can open it up to questions.
Sure.
So let me, I don't know if we have a slide of our predicted expectations, but don't worry about it. So our goal in the long run is to produce 500 to 1,000 new investors to generate $50 million or more in startup investing, and to build a pipeline, an engine, a conveyor belt that activates this long term. And there's a lot of other benefits that we can get into downstream. But the way that those numbers match with $200,000, when I first heard this, I was like, $100,000 or $200,000 is not that much money. It's a lot of people, why will this scale to have impact? And it's this reason. San Diego, what happens is, in year one, the group makes one investment. There's usually like 2 or 3 companies that you get 20 to 40 people. They're going to have different opinions about what to do, right? And what happens is that if not in year one, usually by year 2, you'll get a vote for the winning team. Out of 40 people, 21 of them vote for company A. Company B had 10 or 12 people. Well, those 10 or 12 people start raising money for company B. And so the fund not only invests $200,000 in company A, but they also, maybe by the end of the program, have another $100,000 lined up for company B. San Diego, and by year 3, they were funding, each cohort was funding $600,000, and 3 companies out of the 6 got awards. So and the way that technically works is that there is a special purpose vehicle created for every cohort. The investors themselves join as members of that cohort. They are the legal voting members of the board of that entity, LLC. And we have an agreement that we start with that you'll sign when you come in, but you're the voting leaders of the group. So if you decide you want to add more money to the fund and invest in a second company, you just need to vote on it, you and the board or the fund manager. And so it's powerful because of the community it builds and the opportunities that come when you build community. And that community then gets redeployed, not just in a second investment. So the fund, we're recruiting, we have a deadline, you're gonna join or not, but if you join, we kick off, right, August 12th for our 3-day weekend. But we keep the fund open all the way until several weeks after the final event. And what happens is people who come to the final event and see the 6 companies, they throw money into the fund as well. They sign up. So that fund will go from whatever we raise by closing day in August to, more than that by the end, right? And so you may give more money to the company, you may use money to do other things, give money to some of the other companies in the queue. You guys all get to decide that as the leaders of the cohort. And it's that the connectivity that you create, then each company now has 20 to 40 champions who are allies for it. And you come in with very low risk, right? You're putting in $5,000. If you want to buy 2, 3, 4 units, you're welcome to do that. But it's a very low cost starting spot. And it gives a lot of downstream amplifying potential outcomes for the community as a state and for the startups that come through the program, as well as you as investors.
A couple things.
Why don't we stop there and
I just want to add a couple things real quick, Justin, because I know these questions come up from the fellow investors. So it's $5,000 that goes to the fund. It's about $500 a unit that's going to cover the admin, legal, blah, blah, blah. That gets covered for the life of the fund. Okay. You can buy as many units as you want, but you can only buy 2 votes. So you get 2 units that vote. And then if you wanted to put more in for some reason, say you love the company and you want to get more in, that's fine. But that way we don't have a big pot winning the poker table every time because somebody comes in as Daddy Warbucks, right? We need to make sure that everybody feels like they're getting this. So the whole point is to train people to think like investors, to start asking these questions, to see a bunch of companies. And the final thing I would just note is that what they've found in these other cities that have done this is people come back and do this over and over and over again. And at first that didn't seem right to me. Like, well, once you learn how to do it, why would you do it over? Because you learn something new every time, right? I mean, I've done 1 M&A. Mitch, how many have you done? 7, 8, 10? I don't know, 1 billion. So yeah, right. Mitch learns more every time. There's never a time he's not going to do an M&A process and learn something, and he can still teach me things. And it's going to be the same way investing in these small private placements.
Hey, Tony.
Yeah.
While you're speaking to that topic, can you explain what a unit is? Just get it.
Yeah. So there's 40 investors, but a unit is a $5,000 block. And so we're shooting for 200,000, 5,000 a piece. So that would count as one kind of investment unit block. And at some point we might allow passive units as well. So people who can't be involved they wouldn't be in the voting to decide the company because they're not involved in the due diligence. They're not going through the weekend. They're not taking the time. They can still put money in. They just don't get a vote on where that money goes. They're just riding along almost like a sidecar, right? So we do see people, and we see that in other cities too. People come back and go, well, I can't go through the program this time, but I'd like to I'd like to get 2 units in passive because I really believe in what you guys are doing. So,
yep.
Other questions?